What's good, everybody? And welcome to the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. Please like, please subscribe, please share the episode. I really truly appreciate it. Please note that anything discussed in this episode is not financial advice. Please do your own research before investing into any stock. This episode today is going to be all about ETFs. We're going to talk about what they are, some of the ones that I like, and the ones that I plan to add to my portfolio this year in 2022. So what is an ETF? An ETF stands for Exchange Traded Fund. That's just a fancy way of saying an ETF tracks certain companies all in one fund. So you've got ETFs that track sectors, you've got ETFs that track certain companies, industries, the whole 9 yards. You can have whatever you like in an ETF. Now, before we dive deeper into the ETFs, let me talk a little bit about what I actually do in the stock market in investing. I do a myriad of different things. I invest in singular stocks like Apple, AMD. I trade long-term options, leaps for example. I'm in XLY, I'm in XLK, I'm in Apple, I'm doing some Nike. I'm doing a lot of different things in the stock market. I read articles, I read 10Ks, which are annual reports. I read 10Qs, which are quarterly reports. I listen to earnings calls. I'm always watching CNBC. I'm listening to some of my mentors and my peers out here in the industry and really trying to attack the market and get a competitive advantage. All of that is good, fine, and dandy, and that's great. I personally love doing this because I live and breathe for this stuff. But a lot of people are going to look at me and say, that's a lot of different stuff. And Devon, I'm really not trying to do all of that. I don't have time to be reading reports and doing all the stuff that you do because I'm not as committed as you. Well, investing in ETFs gives you the ability to be a lazy investor. Yes, repeat after me, a lazy investor. The only thing you have to commit to doing is buying the ETF every single month. Whatever investment related capital that you have allocated in your budget, you must buy this ETF every single month for the rest of your life. Yes, repeat after me. You have to buy this ETF every single month for the rest of your life. If you commit to doing that, you are going to have growth in your portfolio over the long term and watch your money get that compound interest rolling and start making money for you. Now that we've discussed about what I do, what ETFs are, let's talk about some of the ETFs that I like and some of the ones that I'm going to be adding in my portfolio for this year. Let's get it. So the first ETF that we're going to talk about tracks the granddaddy of them all, which is the S&P 500. This ETF allows you to buy the entire stock market, essentially, the entire S&P 500. So this ETF is going to give you the diversification that you need and the growth that you need. Now, people that have been in the market for a while may be familiar with the ETF called SPY, ticker symbol SPY. SPY is the most traded stock on the stock market, okay? And the same individuals or the same company that created SPY created this ETF right here, SPLG, ticker symbol SPLG. Now, SPY is trading for north of $400 a share, but this ETF is trading for less than $55 a share. So you can get the exact same exposure with the exact same companies for less than $60 without even having to buy SPY. This ETF gives you a very attractive initial price point so you can get into the market at a cheaper price. So let's look at some of the top holdings in this ETF. So you've got Apple, Microsoft, Amazon, Google Class A, Google Class C, which is Alphabet. You've got Meta Platforms Class A, which is Facebook, Tesla, Berkshire Hathaway Class B, Nvidia, and Johnson & Johnson. Now, if you look at the weightings, you notice that Apple has a 7% weighting and Johnson & Johnson only has a 1.2% weighting. So this ETF is an ETF that you would call a market cap weighted ETF. That means that the companies with the largest market caps on the entire stock market have the biggest weightings in the ETF. Now, I personally like market cap weighted ETFs because it gives me more exposure to the bigger companies, because I love the big boys. I love companies like Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla. Those are the ones that are really making moves and the ones that I believe have the biggest growth in the stock market. So I need as much exposure to them as I can. I hold Apple as a singular stock in my portfolio, but I also want this ETF because it's the number one weighting in it at the same time. This is what I need to have that double compounding that we're going to talk about a little bit in later videos as we go on down the line. So if you look here at the sector allocation, you've got information technology as number one with 28% of the weighting in the portfolio, which is the largest by far. The next you've got is healthcare with 13%, consumer discretionary with 11%, you've got financials with 11%. So you've got some of everything in this ETF. This is what gives you the diversification. You've got real estate, utilities, energy. You've got everything here. So this is why I like this ETF, because now you have the diversification with the growth at the same time. Another reason why I really like this ETF is because of the low expense ratio. This expense ratio is about 0.03. So what is an expense ratio? An expense ratio is pretty much how much you have to pay the advisors to manage the portfolio. 0.03 is a very low expense ratio. It's one of the lowest expense ratios that you will see in the industry. Okay, if you're looking at expense ratios of 0.5% or 0.75%, those are very expensive, and those funds are very highly actively managed, meaning that people are going in and out of stocks every single day. Another reason why I like this ETF is because we get a pretty decent yield. So what is yield? Yield is pretty much the return that we get on our money. So the fund distribution yield is 1.34%. So for every share that you have of this ETF, you're getting 1.34% per year for every share. So a fund distribution yield is very similar to a dividend yield, but it's more complicated and it has more factors included into it. If you want to know more about it, please do some research into fund distribution yield and dividend yield. We're going to talk more about dividends and dividend yield in other videos, but I just want to give y'all an introduction. So this is very important because we want to have our money working at all times, and we want to get returns on our money. So we can invest in the S&P 500 and get the growth from the S&P 500 from the increase of the share price, and we can get money just for holding the shares. We are killing two birds with one stone here. The next ETF that I want to talk about is ticker symbol XLK. This is the Technology Select Spider ETF. All that means is that every technology company in the S&P 500 is in this ETF. Now, when we look at this ETF, we look at the gross expense ratio. They're telling us that they're lowering the expense ratio from 0.12 to 0.10. Now, this ETF, we're paying a little bit more from an expense ratio standpoint. But at the same time, let's look at the performance of this ETF. With this ETF, over the last 10 years, this ETF has produced 23.04%. So, does it mean that we're going to get 23.04%? No, it doesn't. But it does mean that this ETF has a strong track record, and we can depend on it to give us returns year over year. So we noticed that the expense ratio was a little bit higher than the S&P 500 ETF. So we're paying a little bit more, but at the same time, we're getting 7 percentage points to make up for what we're paying. When we look at ETFs, we care more about the performance rather than the expense ratio. We don't want to pay too much for the expense ratio, but we still want that performance to pretty much take precedent over the expense ratio. If we take a look at some of the top holdings, we see some similarities here. We see Apple, we see Microsoft, we see Nvidia, and we got some new names. We got Visa, MasterCard, Adobe, Salesforce, Broadcom. We're getting total technology here. But if you notice in the S&P 500 ETF, Apple was only 7%. In this ETF, we're looking at Apple as almost 25% of the ETF. Microsoft, 21.5% of the ETF. This is what I like to see. I need to see the largest companies as the biggest weightings in the ETF. That's why you've got the big growth, because Apple has a great return over a 10-year time span. Microsoft, Nvidia, all these companies here mostly have great returns. So investing in technology solely is going to give you a great return. So let's do some comparisons between the first two ETFs that we looked at. With the S&P 500, we're getting the total market, right? We're getting the total market and we're getting diversification. With XLK, we're getting solely technology. But the reason why these two would be great together is because if you remember, technology was the biggest weighting in the S&P 500 ETF. So being able to have the S&P 500 to buy everything in the stock market and then have the ETF with the biggest weighting in the stock market, that's going to give you that diversification, growth, and the safety that you need to really allow your portfolio to really grow to higher heights. Now, the last ETF that I want to talk about is ticker symbol XLY. This is the Consumer Discretionary ETF. So every consumer discretionary company in the S&P 500 is located in this ETF. Now, if you look at the expense ratio is the exact same as XLK. The share price of this ETF is $178 per share. Now, if we look at the 10-year performance of this ETF, we're looking at about 19.5% over a 10-year time span. So that's nearly 20%. So this is a very good return with this ETF. Now, why do I like this ETF so much? So let's take a look at these holdings for a second. The reason why I like XLY so much is because of the top two holdings. You've got Amazon and you've got Tesla. These are two companies that I believe in over the long term that will give us great growth, okay? And when we're buying XLY, we have to take this into consideration. You're betting on the United States consumer. Now, the reason why I'm okay with that is because we're going to spend money. We're going to consume things. If you look at the companies here, in addition to Amazon and Tesla, you've got McDonald's, you've got Nike, Home Depot, Lowe's, Starbucks, Target, okay? These are companies that I'm sure that most people that are consuming this content, they are utilizing these companies either every single day, every single week, monthly, whatever you want to call it. I am bullish. That means I believe that the United States consumer is going to continue to spend money over the long term. So this ETF is going to give us the ability to get exposure to the U.S. consumer while at the same time just getting exposed to great businesses in general. So we talked about 3 ETFs in this episode. We talked about ticker symbol SPLG, which is the S&P 500. We talked about ticker symbol XLK, which is the technology sector. And we talked about ticker symbol XLY, which is the consumer discretionary sector. Now, I'm going to be buying shares of SPLG because I want that growth, that diversification, and that safety in my portfolio. I'm also going to be buying shares of XLK because I'm bullish on technology for the long term and I want that growth in my portfolio. I'm already exposed to XLK in terms of leaps, which are long-term options that we'll discuss later. And I'm also exposed to XLY in leaps, which are also long-term options as well. I'm thinking about buying some shares of XLY because I really want exposure to Amazon and I really want exposure to Tesla, but I haven't really decided how I'm going to attack that just yet with my portfolio. So as always, thank y'all for stopping by the platform, right? Please like, please subscribe, please share the episode. please reach out to me in the comments and let me know if you like any of these ETFs that I presented to you here today. Let me know if you're going to be buying them, if you're going to be trading them, whatever you want to do. Let me know if you got some other ETFs that you like better than the ones I gave you, because I'm always here to learn and I always want to know how you all are attacking the stock market as well. So remember, don't pay for it, trade for it. Catch y'all in the next one.